My name is Sabine Döbeli. I'm the CEO of Swiss Sustainable Finance, and also on behalf of Adrian Schatzmann, CEO of AMAS, I would like to welcome you to this session that hopefully provides an interesting insight into a new publication that we launched today. Well, what is it all about? It has a bit of a complicated name. It's called Recommendations on Transparency and Minimum Requirements for Sustainable Investment Approaches and Products. What is the objective of this publication? Well, maybe you are aware that over a year ago, in June 2020, Swiss Sustainable Finance and the Asset Management Association Switzerland already jointly launched a publication, the Recommendations on Sustainable Asset Management. In this publication, we already described the different sustainable investment approaches, but now we definitely go one step deeper, and we want to give clear guidance as to what different approaches are for, what's their objectives, what should you at least be doing as an asset manager, and how should you provide transparency on them. So I have to say it was a collective effort of a work group that was held jointly between AMAS and SSF. And without the work group leaders, without the work group members, we wouldn't be where we are here today, being able to really show you how you should go forward as an asset manager in providing transparency about your approaches and thereby hopefully avoiding greenwashing. But before I hand over to Adrian Schatzmann, let me briefly guide you through the program. And now we have the slides up. That's perfect. I hope the session will be as thrilling as this picture is giving you the impression. So what are we going to discuss with you? Well, after a few welcoming remarks, Adrian and myself will guide you through these recommendations. And we will then dive one level deeper and have 3 of our work group members presenting their approaches and illustrating what the guidance offers them in communicating to clients or also in actual performance. We will then have a closer look at how these recommendations can be seen in the context of the regulation both in Switzerland and in the European Union. And we can, of course, always take your questions in between. But I don't want to be longer. I now hand over to Adrian to make a start for the introduction of these guidelines. Thank you.
Thank you very much, Sabine, and a very warm welcome also from my side on behalf of the Asset Management Association Switzerland. And Sabine, if you could kindly hand over this. I will immediately dive in and ask the first question. Why did we do these recommendations? Why did we think we should work together on this? And I start with a picture which probably represents very well what the average retail investor expects when investing in a sustainable investment products. They want to make a difference with their money. They want to invest in something that is tangible. And while we in the industry often talk about ESG, environment, social governance, many investors, they first and foremost think about the E, the environment, and even within the E, they think about the climate. Now, this is the expectations of the clients. Typically, this is what they get. And don't get me wrong, there's nothing wrong with this product. These are the top 10 holdings of the MSCI World, of an MSCI World Index SRI product. You see the likes of Microsoft, Coca-Cola, Roche. That's not what you would expect if you think about windmills, if you want to make a difference. So there is a mismatch. There's a gap. There's disappointment sometimes. And from this mismatch, it's a small step towards greenwashing. Now I hear a lot of my colleagues telling me, "Oh, investors, they do not really know what they want, what they expect. Their expectations are not realistic. They should be better educated." Maybe, all good. But let's start with what we as an industry can do better, the asset management industry. And that was a bit the starting point for these recommendations. We asked ourselves, are we really clear in our communication with clients what a sustainable investment product is about? Do we really describe what this product wants to achieve and also what it doesn't achieve? And if we are clear, do we provide this information in an easy and an accessible manner to clients? And also then, do we use the right language? Do we use a language that is understood? And again, I quote here the MSCI World Index SRI in US dollar. We're perfect with acronyms, intellectually always right, but we're not understood. That was the starting point. And then we set ourselves 3 objectives. First, we want to make clear within the industry what we understand with different investment approaches. As an example, if we, the industry, talk about impact, what do we mean with impact? And do we all mean the same? And I think we should use a consistent, a common language if we want to make life easier for clients. So to define these different investment approaches and the ESG instruments in details, but also set some minimum criteria for it. Again, impact. What criteria you need to fulfill to qualify as impact? That was the first goal. The second goal was, once we have agreed within the industry, among ourselves, that's an inside discussion, how and what and where do we provide this information to the clients? And also, what are the minimum requirements we want to communicate with each of these investment approaches and instruments? So that's the second goal, communication with the clients, information. And the third one is, now we have different investment approaches, and Sabine will point them out, we'll talk about them in greater detail. We have different ESG, sustainable investment goals, from making a difference to value alignment. Also, we're going to hear more about this. And not all of the ESG approaches meet the same investment goals. So we want to give guidance. We want to establish a framework and make sure that a client, possibly also a client advisor, an investor advisor, that they get some navigation, that they see which ESG instrument serves which ESG investment goal. Before I hand over to Sabine, just a quick word on greenwashing. There's been a lot of talk about this in the media everywhere, probably rightly so. And the way we, again, Swiss Sustainable Finance and the Asset Management Association, and I include the Swiss Banking Association here, the industry, the way we discuss greenwashing is threefold on the investment side. Greenwashing can happen on an entity level with an asset manager who, for example, claims to be a sustainable investment house, but there are not enough people or the wrong people. There's no governance. There's no investment process. There were examples in the media lately. And the recommendations that Sabine pointed out before, the ones we published last year, they addressed quite a bit of that element, entity. Then we have the product level, transparency, making sure that what is in the product is also how it is sold. That's what we're going to talk here and today. That's what's covered in the recommendations. But everything is useless if at the point of sale, where the advisor meets the client, if there's greenwashing, if a product is sold wrongly. And this third element is as important as the other two, And again, in the spirit of collaboration across the whole industry, that area is in particularly looked at by the Swiss Bankers Association. So whenever you hear criticism about greenwashing, always ask, where does it happen? Because that's very important if you want to fix it. With that, I hand back to you, Sabine.
Thank you, Adrian. So, greenwashing, that's what we want to tackle. And frankly, I couldn't agree more with you that a lot of the greenwashing allegations we saw out there in the media, and you saw it almost daily, we read about greenwashing. In my view, a lot of it has to do with misunderstandings related to the goals of sustainable investments. Now, in our publication, we describe 3 main goals that investors can have when they integrate ESG factors into an investment process. Maybe not the oldest, but an important one is the financial performance goal. We know by now that by widening the scope of a financial analysis and taking key ESG factors into account, material factors, we hopefully can improve the risk-return profile generated with investments. That is a valid goal for an investor. The oldest one is probably the values alignment goal. If you think of exclusions, they were very much designed to align an investment with your personal values. But there are other forms to align investments to values. So that's a second goal, also very valid. And it doesn't necessarily mean that such an investment has an impact. But now we do address this third very important goal, the positive change goal. I have to say we purposefully didn't call it the impact goal because we didn't just want to limit that to impact investments. We all know there are various mechanisms of how investors can have impact and can contribute to a positive change. And we will dive into that a bit deeper in the different contributions as well. So these are the 3 main goals that we differentiate in our guidelines. And we also explain which approaches actually match which goal to what degree. So generally, what are these recommendations about? Adrian mentioned it a bit already. I dive a bit deeper now. We have 3 main elements in them. First, we want to explain the degree of contribution to these 3 goals of each of the sustainable investment approaches that we commonly see in the market. The second point is that we specify information requirements on each of these approaches. So we say, what should an asset manager inform about when they claim to apply one of these approaches? What should they communicate to the clients about? And the third element has an element of minimum requirements. So really a recommendation to asset managers about how to perform such a sustainable investment approach. What has to be implemented at minimum for you to claim that you actually apply such an approach. These 3 elements we detailed for 6 different sustainability approaches, and you see them listed at the bottom of the slide. For exclusions, for best in class, for ESG integration, for thematic investments, impact investing, and for stewardship, encompassing both engagement and voting. So for all these approaches, we describe how do they contribute to the different goals, what should you at least do, and what should you inform about. Now let's dive one level deeper, and I do that by the example of impact investing. So I pick out one of these 6 approaches and go through the different layers of the recommendations. Well, first of all, we looked at how impact investing is suitable to achieve these 3 goals: financial performance, values alignment, and positive change. You see the legend at the top right of this slide. So either it's not applicable at all, or it contributes to a certain extent to this goal, to a medium extent, or to a large extent, to a great extent. In the case of impact investing, it can be debated if that actually has a financial contribution. Well, if you look at it from a private market view, if you see impact investing primarily as a private market activity, then of course adding impact investments to your portfolio can improve the risk-return profile of the whole portfolio. But that is a specific effect also dependent on the type of impact investing, which is why we gave it the lowest level. When it comes to values alignment, investing in a stock or in a project that actually has an impact definitely helps you to feel at ease with this investment. It maybe serves your goal. So it has a contribution to aligning an investment to your values. And I think if you look at impact investments also from the perspective of foundations, for example, as institutional investors, they can use impact investments to also support the purpose of their foundation. So they can choose specific topics or specific outcomes to also support the objective of a foundation. So that also has an element of values alignment. We gave it a medium rank. Now, positive change, that's the actual objective of impact investments, to have a positive change on the world and to also illustrate this change, to use KPIs to measure it on a regular basis. So definitely for us, impact investments are best positioned to actually contribute to positive change, always in comparison to other investment approaches, which is why we gave it the darkest color or the highest extent as how it contributes to this goal. So much about the suitability for different investment goals. Now, what do we see as important information that an impact manager has to provide to clients? Well, for all the approaches, we say first you should state in your documentation what investment approach you apply. So give the name of the sustainable investment approach. That goes through the whole recommendation for all the approaches. For impact investments, we actually debated this quite a bit. What really makes the difference for impact investments? I think what you have to be able to demonstrate is a theory of change. How do you, as an investor, actually create impact? Not just how do the companies in your portfolio create impact? What is your role as an investor and how can you contribute to impact? So this theory of change is really what makes maybe a thematic investment an impact investment. Let's say if you invest in private markets and bring new capital to underfunded companies, that is a true impact. Maybe you engage with companies and can demonstrate a change over time. That can also be a true impact. But you have to be able to describe your mechanism of how you achieve it. Then an inherent part of impact investing is reporting about the impact. So you have to be able to demonstrate KPIs that illustrate the actual impact. And we see it as best practice to also refer to one of the standards in this field, for example, IFC's operating principles for impact management. So much on the information that we see as relevant. In terms of minimum requirements, you may be surprised that the list is not so long for impact investing. Well, what really makes an impact investment trackable for a client is regular reporting on the actual impact. Of course, to report, you need a lot of the other processes to be in place. So probably a lot of what I covered before is also contained in this minimum requirement. But you now saw the structure. We go through these 3 elements for each of the approaches in our guide. With that, I hand back to Adrian to also talk about the suitability matrix that is contained in the recommendations.
Thank you, Sabine. You leave me with the most attractive part of the recommendations. And that is where everything comes together. We heard from Sabine that there are different investment goals, sustainable investment goals financial values positive change. And we heard about the different investment approaches. And not, as I alluded a bit earlier on, not all of these investment approaches meet the same goals. And let me explain that with the example of exclusion. If I exclude certain sectors, certain stocks from a portfolio, I'm perfectly aligned. I can be perfectly aligned with my values. But just by excluding a stock, I have no immediate impact. Because the money, there's no fresh money being injected into the real economy to finance new projects. So does that mean a product that builds on exclusion is by definition without any chance for positive change? No, it's not. An exclusion product is not exclusion only. You can combine it with different approaches. As an example, and we're going to hear later about stewardship, about engagement. If you combine exclusion with engagement, the manager can make an impact, can work towards a positive change. So look at this matrix in not as a one-by-one thing, but allow for combinations. And maybe a final word on the shades of blue here. You may disagree with one or the other, and no problem. There was disagreement also in the group. There were every group member had obviously very strong convictions and well-founded convictions. It's not about being exactly right or wrong. There are probably 50 shades of blue in that case. But the key message here is there is a framework. Not every sustainable investment product meets the same investment goals. And use that framework, and we also work with the Swiss Bankers Association for their advisors. Use that framework when we talk about investment products, sustainable investment products. And if we use that, if we live that, I think that's one, it's not the only one, but it's one important contribution towards preventing, combating greenwashing. So this is the theory. Now we go into practice. We have 3 working group members here, and Aurelia, I think you're going to moderate this part.
Thank you, Adrian. Welcome everyone from my side as well. I'm Aurélie Lafay. I'm representing AMAS here in Geneva. And we've heard a little bit about the recommendation and the details of the recommendation, and now the objective is to go one step deeper with some real life example in practice. And just before we deep dive into the different example that we wanted to showcase, it's important to remind, and it's been mentioned, that those recommendations are really the fruit of a consensus. And I wanted to thank the entire working group members that have participated. It includes bankers, asset managers, insurance, so a wide range of the industry. And so just wanted to illustrate that. And so basically, right now the objective is to go one step further with case studies. We've heard about different sustainability approaches, and what we've going to go through is we've got Lombardier talking about ESG integration, so how they view and how they incorporate ESG integration on their part. Then we're going to hear from Maxime Perrin. Then we're going to hear with Nicole Brunart, we're going to hear more about stewardship on the BlackRock side. And then Rubel Feldman will go through the best-in-class approaches at Swisscanto Invest. So with no further ado, I'll let Maxime go through the Lombardier and ESG integration. Thank you.
Hello, everyone. So the working group member for Lombardier was Robert de Guigné. So for those who came to see Robert de Guigné, I'm sorry he lost his voice, so I'm replacing him. You'll just have to put up with that. Maybe next year it'll be him. So here I'm going to illustrate the recommendations and the framework. Can you hear me? Good. How we integrated the SSF AMAS framework and recommendations in a fund which is the Target Net Zero equity funds. So these are low tracking error, even very low tracking error strategies that aim to decarbonize investments portfolio at the beta level. In other words, we invest in companies or we overweight companies within an index which are readier, more credible in their decarbonization challenge, and we underweight those which are non-credible, not ready, facing all kinds of issues. You'll recognize the positive change, financial performance, value alignment framework, which we find incredibly useful in describing how the strategy operates. Positive change is simple. We target net zero, we align the objectives of the fund with the Paris Agreement targets, and we do this by having a certain amount of rules. First one, 30% lower carbon footprint, and a temperature alignment, so a forward-looking metric measuring the credibility of companies' decarbonization challenge in temperature levels, and the temperature, indeed, of lower than 2 degrees. So the positive change is obvious. Invest in companies that are decarbonizing fast and credibly, and underweight or exclude companies which are not. Financial performance is represented here through this overweight, underweight in a low tracking error strategy. We call the companies that are well aligned ice cubes, the ones that are not burning logs. I'll come to explain that in just a second. And the value alignment in a strategy which is low tracking error is going to essentially involve exclusions and restrictions. We have absolute exclusions on controversial weapons, tobacco and food commodities, and we have underweight obligations on companies involved with severe controversies, as well as unsustainable business practices, coal mining, unconventional oil and gas, etc. Now, just a quick understanding of what we talk about when we talk about ice cubes and burning logs. I'm not going to spend a huge amount of time here, but it's important to understand what it means when we talk about sustainable objectives. On the vertical axis, you have a company's, or even a portfolio's overall carbon footprint, in other words, what a company is emitting today or indeed just yesterday. And on the x-axis, the horizontal axis, you have the future. How credible is a company in its decarbonization challenge? If you look at the horizontal axis, you'll see that it's denominated in temperatures starting from 1 degree, ending at 6. 1 degree is the global warming that we are already responsible for. 1.5 is the objective of the Paris Agreement. 2 degrees is the upper limit set by the COP21 and the COP26. And then above 2, you go further up to 6 degrees. What this implies is if you give a company a 1.5 degree temperature, this implies that the company is credible and believable in its decarbonization to net zero by 2050. If it misses this, it's above. If it beats it, it's below. That allows us to identify companies which are true opportunities. We go back to the performance objective. Identify those which are truly opportunities because they are high emitters today, but will decarbonize quickly, and those which are burning logs, which indeed are problematic because not only do they have high emissions today, they're not credible in the way they're going to reduce them. Now, if we move on to the recommendations on the categorization of methodologies, we recognize here 3 different elements of the framework. Exclusions, I mentioned them. We exclude controversial weapons, nuclear weapons, companies involved in nuclear weapon manufacturing and sales to non-signatory of the Non-Proliferation Agreement, and we exclude tobaccos outright. We also do negative screening specifically on certain activities through underweights, which I mentioned. And then we have a certain amount of positive screening, certainly on the basis of temperature, as we'll see in the portfolio in a minute, where companies which are unaligned, unready, incredible in their decarbonization efforts are underweighted. It should note that the portfolios of all the Target Net Zero funds must have an equal or superior overall ESG score using our ESG materiality methodology. And then finally, the ESG integration for low tracking error is not an incredibly deep one, but we do increase the exposure, as you'll see, to companies that are well aligned, certainly from an environmental point of view, with the key objective of our time. And I'll finish with a quick overview of the portfolio. Now, clearly, I'm not going to go through every line here. I just want to point out the chart to the right, which shows you the overweights, underweights of such a strategy based on the framework that I showed. Carbon footprint on the horizontal axis and temperature alignment on the y-axis. What you see here is clearly overweighting those companies that are aligned with Paris Agreement targets, underweighting those which are unaligned and therefore problematic from an investor's point of view, because the red companies here which were underweight are those which face regulatory friction, regulatory barriers, more difficult access to capital, problems with competitive advantage, etc., etc. The result, which you can see in terms of transparency to investors, is an overall temperature of 1.7 degrees versus that of the MSCI World at 2.9 degrees. So you apply the strategy to reduce your exposure to those companies that are unaligned. I will leave you on that note and pass over the microphone to the next person. Please feel free to ask questions later or to catch me on the way out if you want to. Thank you very much indeed.
Thank you very much, Maxime. Now we all know where we have to invest in. First of all, let me say a big thank you to you, Adrian, to you, just to be able to have actually participated to this working group, because I think it has been really an extraordinary, very productive working group. We have had the leadership of Sabine, we have had the leadership of Katja earlier on, and now we have Aurelia who joined us recently, and obviously Adrian as well. It has been really a cool experience, and we are happy to be here at Building Bridges with you. I think Building Bridges is absolutely core to us, and it's core to our future, and we're very happy to build bridges also with regard to regulation. And I will not be presenting just one strategy, one product strategy, because stewardship at BlackRock is a little bit a different animal. So why is that? I'll start with a quote that actually stems out of our stewardship global principles. And that already shows you, yes, we have formalized this thing. And what is it about? Well, stewardship at BlackRock, it is one of the key pillars of our fiduciary duty to clients. So we really want to invest in stewardship, to act on stewardship in order to achieve the long-term best interest for the clients on behalf of whom we invest. We don't have own assets, we only invest for our clients. And stewardship is one of the key pillars that we have to build this forward. And if we want to take a practitioner's perspective, and yes, in the paper that was just introduced before, it's actually 4.6. It's called Active Ownership and includes both voting as well as engagement. I wanted to share with you that at BlackRock, this is always applied as a cross-section, as an overarching topic. So Adrian mentioned before, in the sustainability matrix, it can be a combination of different approaches. Well, for BlackRock, stewardship is applied across the entire portfolio. And for us, stewardship starts with 5 principles. You see them here. It's around board and governance, obviously topics like DE&I, topics like efficiency of boards, also incentives aligned with the value creation, if that is fine, the strategy of a company, if they have a purpose and they go in the right direction. And then obviously topics which are more important for us, also with regard to the ESG targets around climate and natural capital, and also the social aspect with the impact of business activities on people. So stewardship at BlackRock, it's a whole range of topics, and today we will be focusing on the ESG aspects of these topics. And why is it so different? Why is it not one strategy? I know there are asset managers that offer specific strategies only focusing on stewardship, where they actually start at the beginning of the investment process, they identify the companies in which they want to invest because they feel with these companies, with stewardship, we can make a difference. Now for us, we have about 2/3 of our assets in passive investments, and it is our mandate to invest for our clients. They take the decision where they invest, and then we just do stewardship for them in the best possible effort. So we do it for all the debt and equity where we are invested. We have both engagement and voting combined, so we don't have two separate strategies, which also leads to the fact that if you look at the recommendations of the paper, which distinguishes between voting and engagement, we have one guideline, one principle that is holistic and integrated. And we don't have a difference between active and passive. And what is very important, it's mandate neutral. And that means we do it for sustainable strategies, like if we have an impact strategy, we would also do stewardship, but we also do it for normal traditional strategies. And I think this is where we had one of the challenges as well of the working group, because different asset managers think differently about these levels. But I think the beauty of this whole framework that came out now is that we found something that was kind of the least joint denominator, I think you call it. And I think also with the framework, with the different aims that we are fulfilling, and also with the different information requirements, we made a really big step forward. And if you look at these principles and the priorities that we have, you already see that we are also very much looking at the aims, and especially also the positive change aim. So how is stewardship implemented at BlackRock? Well, obviously, we have engagement. If we look at engagement, for example, this is the ongoing constant dialogue that we have with companies. For example, we had Shell who wanted to decrease their carbon footprint, and we were very engaged with them in helping to decrease their carbon footprint. Then, obviously, we have voting. This is something where at the annual general assemblies, we actually take a vote. Sometimes we also vote against the company if it's in the long-term interest of the end investors. And an example here is, for example, that we really wanted the companies to be more explicit with regard to their ESG footprint, with regard to the carbon emissions that they have. And we have been very explicit about asking clients or corporates to actually share the TCFD report. And we have one example of a company, I call it Daimler, because it's public knowledge, where we actually we asked them to do the TCFD reporting. We were very explicit about these expectations of ours already before, but then they didn't do it, so we had to vote against. And the third thing where we do stewardship, that is called promoting thought leadership. It's actually where we really want to move the world forward. We really want to help, and this is why it's such a pleasure to be part of this working group with you, Sabine and Adrian, and the other team members, and also where we really want to show, you can do more. And we will afterwards see what we have already done with regard to reporting. And what you can see is that BlackRock is really very transparent. We have policy, we have principles, we have guidelines, and we have a lot of reports. So this is something where we want to be really transparent so that people can learn what we do and see what we do. So quickly, the journey of stewardship at BlackRock. Sustainability has always been very important for BlackRock. But it's in 2020 where we started to be much more vocal about it. That was when Larry Fink said sustainability risk is an investment risk, and we need to make sustainability the new standard of investing. And this is also where we changed the perspective on stewardship. We suddenly got much more open. We have always done stewardship before, but it's since then that we are more public about it. And now, this year, we actually made another big step forward. As you know, we committed to net zero, and we also committed to measurement and transparency. So actually, tomorrow, we will also have a nice publication going out about the measurement alignment of our portfolio, and also the percentage of our portfolio that is aligned to net zero. But it's also other things that we did. We invested a lot in new products, especially in the ESG range. Like in all the different strategies that we have seen before, we have increased the options for investors because we believe it is important for the investors to have options. And obviously, we also focused a lot on stewardship because this is getting more and more important. So we increased the team. We have more companies where we are in a more intensive, stronger dialogue with them. And we also updated our policy. So what are the key things of our 2021 stewardship commitments? Well, I told you, we want to focus more on the impact that the companies can have on ESG. So we want them to acknowledge climate risks, ESG risks, and we want to have transparency on that. So this is why we ask them to really take this into consideration and also define a strategy with regard to sustainability that we can then follow and that we can, also act upon. And then we also do much more shareholder proposals. We have started to do this newly now. At the moment, it's only about 2% of our total votes, but it's definitely increasing. And as I said, we are very transparent about this. So we have principles, we have guidelines, and we have a lot of reports that we do in order to be really explicit about our stewardship approach. This is a big team. We have 65 people globally, 71 markets. And now we also wanted to see what is the information needed actually in the context of our working group. What is the information we want to show to investors? And I can give you now some key KPIs to actually show what we have been doing and just also basically demonstrate where we are active. And I can tell you, these are pretty big numbers now. So we have 13,000 companies that we follow for whom we do stewardship. And out of that, we had 17,000 meetings where we voted, 165,000 votes where we actually, voted on something. And we are not always positive. Sometimes we also need to be negative. So in 6,500 cases, that is about 4%. We actually needed to be negative as well, or we did not say anything, because we did not feel that the company had reacted to our expectations or had done the most they could in order to address this topic and to move towards net zero. And then finally, there is this group of 1,000 companies that are in the climate focus universe. These are the companies that are the largest CO2 emitters. The numbers has increased from the year before to this year from 440 to 1,000. And this is where we really do a lot of engagement with them. And also here, unfortunately, in some cases, we had to vote against them. But it clearly shows that you can have a huge impact. So the positive change goal is really something that we managed to do with this strategy. And it's something that we managed to do across all our holdings. And if you look at overall our attitude, well, BlackRock has gotten a bit more critical over the years. And I think that is also our role. And that's also how we help the investment world. So if we summarize the practitioner approach, so you see, we have a lot of principles. So we want to be really transparent. And we want to be open. And we are also very open to engage in dialogues with people. And then we have a lot of reports. If you look on the internet, you find case studies. You find report of our BIS team overall and what they do. You find also statistics about which companies we have engaged with, what were the topics that we have engaged with. So if you look at the paper and you see what are all the things that are required, and there's a lot about how many people we have engaged with, or how many companies we have engaged with, how many negative votes we had. So all of this you will find, but not for one strategy, but for the overall company. And what is also quite cool is really these case studies where you see how did we engage with a client or with a corporate, and what was the outcome. So with that, if we look at the aims that this strategy has defined within the context of our study, I think we can say the positive change goal is definitely the one where we're most closest to and where we have the highest impact, even if I should not use that word here. Then obviously increasing the sustainability footprint of a company also helps its long-term performance. So also the financial performance, the risk-return profile improves if we do that. And with regard to the values target, well, you need to own a company in order to influence, to express your values. And as long as we do engagement, we can definitely do that. So with that, I'm very happy to hand over to Ruben. Oh.
Does that work?
Yes.
Quick question, Nicole. Do you see a difference between passive and active stock holdings? I mean, in terms of engagement, a passive component you cannot simply divest even if you disagree or you cannot engage with. How do you handle this?
That is definitely true. So in passive you cannot divest. That's why it's even more important to be very explicit about stewardship and how you act on stewardship. And one thing that is really cool that we have done just recently, we have actually started to talk about this at the beginning of October. We are now offering, as of January, we're offering some institutional investors the possibility to choose their own voting strategy with regard to the passive investments. And this is because we feel, A, we want to offer products but also services to the end investors or kind of pension fund asset owners. And B, because there is also the digitalization which makes it possible to do those kind of things. So we have worked with ISS, with Broadridge, to see what could we do together. So this is something which we have just recently launched, and we will offer them the possibility to say, either they say themselves how they want to vote, or they say, we want to vote with one of your third parties, or, yeah. So that is definitely something that is underway. But I think, especially us being such a strong passive house, we need to be very, very dedicated with regard to stewardship on passive funds. Welcome. Any other questions? Yes, sorry. Shall we take them later? Yeah. So I hand over to Ruben, and then, if not, I'm also around afterwards, so if someone wants to talk.
Thanks. It's great to be here. Thanks to everyone, and I hope that you still have some attention span left. So I'm going to test your attention span right now. We've tried to set all of our product framework within one slide relative to sustainability. We have 3 product lines, which are described here: traditional, responsible, sustainable. You'll notice that all of our active strategies are either responsible or sustainable. And this involves different degrees of sustainability integration. There are some common points, though. For example, voting and engagement, as we've just heard a lot about, is applied on all of our assets. So even on the traditional, where it's all passive, very little decision power, we still apply voting and engagement. We also still have a list of exclusions. This is probably because if some of these names that were in the list showed up in our banking system, the whole thing would crash. So we do exclude them from everything. And the exclusions are obviously more progressive. So the more sustainable the product line, the more exclusions are applied. And we also have a similar process with ESG integration. So ESG integration, from what we describe it, is not only integration in the sense that it's integrated into the investment process, but also in terms of the best-in-class and the positive selection aspect. So we do have exclusions that are based on ESG. ESG for us is a metric of operational excellence. So it looks at environment, social, and governance standards that are applied within the company to determine whether a company has a good strategy and a good application of these principles that are not only in line with our values, but also in line with what we believe is beneficial for good financial performance. In the sustainable product line, which is a little bit more, let's say, sustainability geared, it's much more than positive selection. It's really more best in class. So here it's not just excluding, let's say, the worst, but it's really about looking for the outperformers and the leaders. We have the obviously a climate strategy. All our active funds are Paris aligned, but I'm not going to delve too much in detail in here. And we also have what we call impact investing. Of course, the term is a little bit contentious, but here we look at alignment of goods and services. So it's no longer about operations, but it's really about the goods and services of the companies and sovereigns as well. That are how are they aligned to the Swisscanto investment themes, which are intrinsically linked to the SDGs as well. So in terms of ESG, so here we have an ESG integration, and since I'm on the strict instructions to focus on the best-in-class and positive selection part, I will try to not delve too much into how ESG is integrated fundamentally in all investment processes and decisions. And the logo has gone a bit weird there in the middle. We have, depending on the product type, we have different types of exclusions based on ESG. So as a standard, all of our responsible and sustainable funds, so anything that's not a plain passive traditional fund, has 20% laggards, 20% laggards rule out. So any company that has the lowest score in its peer group and it's in the lowest quintile will be very difficult, or if not impossible, to invest in. So on the passive side, this is a hard rule. On the active side, we have portfolio managers have the ability to contest the score, because the law of large numbers is great, and usually the average is on average correct. But if you take any ESG score of any company or of any country, you can say with certainty that the score is not correct. And so with the ability to contest a little bit of the score, and it has to be justified and go through due process, we have the ability to bring back a company and make sure that data issues are not the reason for a missed investment. So here we have the requirement, the basic requirement for the recommendations that, of course, the ESG score must include all three dimensions: environmental, social, and governance. These are all intrinsically linked as well. A bad governance often leads to bad social criteria as well as a bad environmental strategy. And this is used as a way to screen out companies that will suffer in terms of performance because they either have bad governance or they have a poor environmental strategy that is not going to be compatible with future regulation or future consumer demand, or they have bad social KPIs, which means that they will start to lose their workforce, or that they are not able to attract the required workforce, or that they interact badly with the societies in which they operate, which means that they will start having legal problems pretty quickly. And so all of these for us, these are material for financial performance. And this is not something we say lightly. This has been discussed at very long length, that ESG for us is financially material across all asset classes and across all potential implementation styles, passive or active. And this means that we see ESG as a way to drive performance. We have a lot of studies that show that laggards in the ESG space tend to systematically underperform. And for us to remove that part of the universe as sort of a standard rule is a way to generally increase the average return of the investment universe that we put forth for our responsible and sustainable products. On the more best-in-class approach of the sustainability of the sustainable product line, so here the aim of the sustainable product line is to look at companies and service providers that will have a goods and service that has a positive contribution to the SDGs. So if companies generate a revenue in an area that actually is a solution towards achieving the SDGs, these are the companies that we want to focus on. And so here we look at specifically companies that have a higher than 50% threshold of revenue linked to the SDGs. And for this, we have a very detailed database that I'm not going to go into too much detail right now. But obviously, the huge opportunity of sustainable development goals that will be achieved or should be achieved by 2030 and going forward to 2050 represents an opportunity set that is attractive to certain investors, and this is why we have the sustainable product line, where there is a different conviction of the investor, where they believe that they're willing to take on more risk to achieve a higher potential return. So we're not making a statement whether risk return is better or worse, but it is certainly different. There will be a higher risk, there will be a higher tracking error versus standard benchmarks. And they will systematically invest in companies that are compatible with an SDG achieved world. So in terms of specifically the ESG positive selection and best-in-class approach, this is used throughout the entire offering, so every active product has this process. It's a multi-layered approach where we do have exclusions, voting and engagement. We have the ESG integration as part of an entire process. But here what's important is also to talk about the actual score itself. So we have issue with a lot of ESG scores that are available in the market. As we saw in the earlier slide where Microsoft is a 10% overweight in an ESG index, principally because it's market cap weighted, but also because there is a huge correlation in ESG scores and company disclosures. So if you drew a correlation line between the amount of information a company discloses and the ESG score across multiple ESG data providers, you will find that 75% of the score is explained by disclosure. So actually, you wouldn't even need to look at what information is disclosed. If you look at the amount of information available, you would automatically get the best ESG scores by selecting the companies with the most information. So for this reason, we have our own ESG score where we are able to select the KPIs that we look at, which means we want to look at KPIs that are not necessarily disclosure-based, but actually look at where there's materiality and actual discrimination between companies that is not necessarily linked to market cap, because obviously big companies have a much bigger budget to produce a lot more information. There's also a language issue where a lot of providers only look at company reports in English or information in English or certain few select languages. Certain regions do not have those languages available, or it may be the second or third language, which means that it would require an even bigger budget to produce the documentation in those languages. And then there are cultural issues as well. So if you look at the regional biases, they're huge. The European ESG score on average is nearly twice that of emerging markets, significantly above North America as well. And it's not necessarily to say that Europe is more sustainable, although you could argue it is slightly, but it's also that there is regulation that forces companies to disclose, which means companies on average have a lot more information available, which means that ESG scores are simply much better for European, especially European large caps. So we have our own score where we take information from multiple providers at the most granular level possible. We integrate that into a system and try to iron out some of the biases without trying to create something too complex and too mathematically unexplainable. And as part of the recommendations, we explain this score in client presentations, and we try to make the client understand that we're not just going to be aligned with the MSCI ESG score, so don't be surprised if we don't always get a AAA on the MSCI ESG rating. Obviously, we measure the ESG performance of all investments that we have in the portfolio. There's also an issue of missing data. So for example, for Swiss real estate companies, we tend to go a lot deeper in the Swiss market than general providers provide data for. So there we have created our own questionnaire where companies can submit data to us, and we integrate that information. We implement the best-in-class approach by nearly systematically removing the bottom 20% relative to the investment universe at hand, but active portfolio managers have the ability to bring them back if there is a requirement. And obviously reporting is quite important for transparency and the avoidance of greenwashing. I'm out of time. Thank you very much.
Thank you. Thank you very much. I think we now have about 15 minutes for questions. 10. And so for those who follow us online, you can also ask us our question using this this app. So with this QR code, basically you've got an app where you can ask your question, but maybe first in the room. And maybe I'm going to ask the speakers to come back on stage. I think there were a few questions for you, Nicole.
you. So,
Hi. On the engagement and the stewardship, I was wondering, how do you collaborate with other entities that have the same purpose? I'm not sure if we can say collaborate, because maybe legally there's some kind of independence issue there, but how do you interact? I mean, combined firepower is obviously the idea.
you know, we are also part of certain associations. We are UNPRI, we're part of the Climate Action 100. So in that sense, we would collaborate with them. So it is definitely not something that we're excluding. It's something we are open to.
Just a question online. Can you explain the mechanism of engagement in case of passive investment?
Yes, so basically we do not distinguish between passive or active investments. We just focus on the company that we are invested in, be it passively, be it actively, be it via debt or be it via equity. And obviously, one thing to add, and that also builds on your question, so especially for the ones where we are passively invested, we don't have the option to draw the ultimate conclusion, which is to de-invest. So this is why engagement and the ongoing dialogue is much more important. And then obviously also, you know, you can vote against board members, and that's before you actually need to divest. So you can also do some voting to some extent, but you just don't have the option to de-invest.
Thanks.
Thank you. A more specific question: how do you introduce the EU taxonomy topic in your? Did you discuss about it in your workshop?
Do you want to take it?
Not that I want, but I will. Yeah. Yes, it was an important topic, and it was. We finally decided not to include it because SFDR is still fluid. Things are still developing. If we had waited for the moment to have full clarity on SFDR, we would not be here on stage today. But that doesn't mean that we will not work on it. I would also say the recommendations are very much complementary to SFDR. If you tell a client this product is Article 8 or 9, they have no clue. Here we provide you with content. We give Article 8 or 9 a life. But looking ahead, that is definitely something we will try to bring together. Yeah, good question. Yep.
There are a couple of questions online. Are the AMAS SSF recommendations standards binding? So who wants to take that? Can also answer, which is basically no. They are recommendations at this stage. Regarding passive investment, if companies don't collaborate, how do you manage the situation as you can't exclude the stock?
Yeah, I guess it's the same answer as before. It's really very dedicated engagement. And if you look at the reports that we are issuing, you know, it's not only, we are not alone on this world. And if we have problems with a company, I'm sure other investors will also have problems with the same company. And then together, I am pretty confident that we can move things forward. And honestly, like, I think it's amazing to which extent, if you talk to corporates, to which extent they have also heard the clock ticking and to which extent they are also moving forward. So I think there is this fantastic sense of urgency and a need to move forward. And I think we're all going there.
Maybe a question for Ruben. How do you measure the impact on the SDGs at Swisscanto?
So we don't pretend to have impact, but we would argue that driving flows to a company that has a positive contribution reduces their cost of capital, which perhaps enables them to conduct more projects by reducing their weighted cost of capital. And similarly, by taking money away from companies that are, let's say, incompatible, or by not investing in companies that have, let's say, a negative impact, you could also increase their cost of capital, which increases their reduces the amount of projects that then they can take on. So, you know, obviously, $1 in Apple has very little impact, but if all asset managers do that, then you start to have an impact.
Thank you. Any question in the room? I think Sandrine, that's...
Thank you. Well, one of my questions was already asked. It was about for BlackRock with the passive gestion, how you do to have really an impact when you vote. But then you show us a slide where you aggregate the abstention and the negative vote. And I wanted to know what is the real percentage of no? Is that more abstention? What is the difference?
I think it actually shows on the chart even. It says the number of, I think I would say 4% in total negative and abstentions and 2 of 50-50. So 50 so
abstention and 50 no.
2% abstentions and 2% real no's.
Real no. Okay, thank
But
you.
the thing is, you know, our philosophy is the no is really, it's just the last resort. We don't actually want to have to say no. We want to have the dialogue and the engagement with the companies before we do have to say no. So that's why, you know, you can also say it's a more constructive way of collaborating with the corporates.
Yeah, thank you. Wonderful presentation and panel. As the session is also in the SDG jungle, the question is maybe an educated guess on where do you see the ESG rating and rating agencies? Is that a further, do you expect a further proliferation, inflation of rating and ranking agencies? Or do you expect maybe a consolidation and in a few years we have just one or two like the Moody's and S&P still assessing the ESG impact of the companies?
Well, what we're seeing a lot of development is now in artificial intelligence. So the collection of data through models as opposed to through the company disclosures. So this is going to definitely change the landscape. I think if there is a concentration of fewer rating providers, then it will become it would be a pity, because they are essentially opinions, and just like credit ratings, actually. But apart from credit ratings, these are much more soft topics. And to say that a company is AAA versus BB has to be taken into perspective with respect to what the KPIs are. And so if you have one opinion and that becomes the rule, then you have a very dangerous cycle where companies basically just have to align to those principles. You also have a very high propensity for greenwashing. And actually what we're seeing, at least in asset management, is that increasingly asset managers start to have their own interpretation of ESG and start to use the data as opposed to just using a rating from an external provider.
Yeah, thank you very much for the presentation. I also have a question on this new document, on these recommendations. Where do the working group members stand at the moment? So from what I understand, you have agreed, let's say, on the different ESG investment approaches. And as we know today, the Swiss banks still don't have a harmonized approach. Some of them have, let's say, 4 themes, other organizations have 6 themes. So I think that is a first step maybe to standardize. Then also when it comes to the sustainability goals which have been presented in terms of financial performance, values alignment, positive change goal. So where do the working group members stand today? Is it at the stage of being discussed? Has it already been decided that this is going to be, let's say, the way it's being implemented within the organizations?
Two things on that. First, what you see here is indeed a consensus. Yes, it's not under discussion, but it's been agreed on. So what you see here, but that's not the end. If you followed the communication from the Federal Council last week on the 17th of November, you would see that this is just the beginning. They expect us, the industry, to organize ourselves, to regulate ourselves with regard to greenwashing, and that is the natural next step. We need to come up with a self-regulation, and a self-regulation ideally that is FINMA acknowledged, and by then, if you're at that stage, it will get binding for all our members. So what we have here and what we discuss here is a very important first step. It lays the basis. We agree on terminology. We agree on the way we look at the industry. And on this, we build now with the next step.
Can I just quickly add something on this? but I think it is important to realize that it's not, we don't have 6 exclusionary approaches. This framework, and that's also the beauty of it, allows also for combination. It allows for different approaches, and the work that we'll have to do is now to really bring this to a level that we can then make a self-regulation out of it that holds the flexibility while also giving guidance, because at the end of the day, this is also for the end investors to have clarity and avoid greenwashing, as you said, Sabine, at the beginning.
Okay, we have one more question just to meet the time, and I'm sure afterwards there's plenty of opportunities for further questions.
Great. I have a question for Lombard Odier. What I found very interesting is that you quantify the ESG impact as a number of a temperature rise. And I wonder how you use that number to actively manage your portfolio. Because I'm dreaming of banks that have a fact sheet where they don't only quantify the financial performance of the last 5 years, but also quantify the ESG impact that they have had over time.
Yes, so it's a narrow metric. It's only measuring the credibility of decarbonization. So hardly can be the magic metric to measure ESG more broadly. But it is, the metric we've developed on temperature is essentially the application almost systematically of all the TCFD recommendations on climate investing. In other words, for those who don't know, the TCFD is the Task Force for Climate-Related Financial Disclosure. It's a mandated body by the World Central Banks, and they gave a number of recommendations, the first one being that decarbonization needs to be looked through forward-looking metrics. All temperature is simply a forward-looking metric on the future of decarbonization. The beauty of that is that it allows you to look at a universe of companies and include those which are high emitting today. Because if you only exclude those which are low emitting, all you're doing is investing in decarbonized or uncarbonized assets. You've got to be able, if you want to invest in a transition, to expose yourself to sectors, activities, and companies which are high emitting. That's why the forward-looking metric is necessary. Then you have 26 other recommendations, which I won't list here one by one, but there's a few key ones, including the fact that you need to look at the entire responsibility of CO2 emissions, so scopes 1, 2, and 3, for those who speak technical climate change. You also need to be able to compare individual companies with the most likely best trajectory of decarbonization. Not compare it with the decarbonization of the entire economy or even of the entire sector, but compare companies' efforts with the real possible change that could be done. There's, of course, 23 others that I won't discuss. But the beauty of this is that it indeed measures, it allows you to be diversified in your allocation. Clearly, there's progress to be made on these metrics. Lots of people are working on them. I'll just give you 2 examples of things that can be subject to progress. Scopes 3, so indirect emissions, are always estimated, even by the companies that disclose their own Scope 3. You're always dealing with estimations. Those can be done better as the information comes forward. And secondly, everything that has to do with independent evaluation of companies' own targets. We can't trust companies blindly when they say that they're going to decarbonize by such and such a date or by such and such a percentage. You need to apply judgment. That's something that we do systematically, but over time, the quality of the targets and the independent verification will have to be more broad. Sorry I spoke so long, but it was a good question, so I'll take it.
Thank you very much. And thank you very much. There are a lot of questions also online, so I guess maybe if we have time later to address them. But thanks again for all the speakers, Maxime, Nicole, and Ruben. Thank you very much.
Mics, please. No, I think it doesn't work. Yes. Do you hear me? Good morning, everybody. A warm welcome also from my side. My name is Katja Brunner. I am Director Legal and Regulatory at Swiss Sustainable Finance. And after these very interesting contributions and insights from 3 different asset managers, it is now time to deep dive also into the regulatory landscape. Let me give you Let me give you first an overview of the scope of my presentation. The objective is to give you a big picture of how greenwashing is addressed in the different legal systems in Switzerland and in the EU, and also how the AMAS SSF recommendations of December are embedded into the regulatory landscape with a focus on Switzerland. And as a reminder, please keep in mind that the basis of the new recommendations, as already mentioned, are the recommendations we published last June. So, as a starting point, I think it's important to have a look at the term of greenwashing, as the legal system of many countries have different approaches to address this topic. Based on the IOSCO report of November, greenwashing is the inappropriate use or deliberately misrepresented use of sustainability-related practices, products, and disclosure that vary in scope and severity. Greenwashing can happen by using inappropriate sustainability-related terms and when disclosing policies and procedures at entity but also at product level. There is either a lack of information or a misrepresentation of sustainability-related commitments or a product's sustainable characteristics. Now, let's move on to the Swiss regulatory landscape. How does the Swiss financial market regulation address greenwashing? The term greenwashing is neither defined nor used by the Swiss financial market law. However, where investor protection provisions apply, greenwashing practices are tackled, in fact, by many articles. The keywords frequently used are misleading, false, or deceptive. The slide also provides an overview of the key financial market regulation. We have the Financial Services Act, the FINSA, which is applicable at the point of sale. And we also have CISA. This law is applicable for funds and sets out product-specific rules. Now, for asset managers or funds when manufacturing products, CISA is applicable. I will come back to this later. How does the regulator address greenwashing? In November, the Federal Council instructed the Federal Department of Finance in collaboration with the Federal Department of the Environment, Transport, Energy and Communication and FINMA to make a proposal by the end of next year on how financial market legislation could be amended in order to avoid greenwashing. Now, FINMA refers to Article 12, CISA, which specifies that the names of collective investment schemes or funds must not provide any grounds for confusion or deception. FINMA published this November also guidelines and sets out requirements for sustainability-related funds and regarding transparency and reporting at fund level, and also regarding organizational requirements at the institutional level for managing funds. So here we are talking about funds with the attributes sustainable, ESG, or green fund. So this was, just for reason of time, also a very, very short summary of the Federal Council's and FINMA's measures regarding greenwashing. Let's now have a closer and very general look at the legislative hierarchy in Switzerland with the example of CISA. Now, you know, this Parliament adopts or amends law. The Federal Council amends or also adopts ordinances which are a little bit more detailed, and if it is explicitly also stated by federal regulation, FINMA has the competence to adopt its own ordinances and to set out more detailed rules. Then traditionally, and this is something special also with the CISA, as this subject is very technical and very complicated, AMAS provides directives on product levels, and as Adrian mentioned before, these directives normally are recognized by FINMA as a minimum standard. This means that the directives of AMAS are binding for the whole financial market. Now, with regard to ESG and greenwashing, as mentioned before, the Parliament and Federal Council, or the Federal Council, just decided in November that it will not amend until next year also the federal law. And as mentioned before, also FINMA published some guidance. Now, the guidance FINMA published is not really an ordinance, it's not really a regulatory tool. But with this guidance, FINMA makes a kind of sort of a report on its supervisory activity regarding Article 12 CISA, which is addressing climate protection. So at this stage, also, both recommendations of SSF and AMAS are non-binding. But I also want to mention that FINMA in its guidance also refers a lot to the joint recommendations for sustainable asset management we published last year. With this, let's move on to the EU regulatory landscape. Well, in the essence, the Sustainable Financial Disclosure Regulation was created to combat greenwashing by fostering transparency for products. Disclosure is required at entity, service, and product level. And I think these slides you all now know very well by now. In order to create this transparency, financial market participants have to classify products clearly and consistently for investors. Financial market participants have to show on their websites and prospectus which products are Article 8 and which are Article 9 products based on their individual interpretation of the regulation. But the intent of the SFDR is not to focus on the importance of disclosure, or is to focus on the importance of disclosure, but rather than as a classification scheme. And this means also that once a financial market participant has classified a product, it is still up to the investors to assess whether a particular Article 8 product, for example, provides ESG characteristic they are seeking. So with this different interpretation also of the SFDR, this leads also to different approaches, and with the result that there is a wide range of investment products classified as Article 9 and 9 products. And in this sense, there are similar strategies or approaches featuring both categories. So in this sense, the SFDR does not set out requirements regarding sustainability approaches as we are just discussing it. And with this, I want to conclude the recommendations of AMAS and SSF hopefully they are a helpful tool for asset managers to communicate clearly and in a more standardized way with the client in order to avoid greenwashing, with a special focus on sustainability approaches. They are complementary to existing and upcoming national and international regulatory frameworks. And of course, these recommendations do not contradict any legal obligation, nor does it discharge the asset managers from such obligations. Now time is running out, and if you have any questions, I'm also happy to take them after. But with this, I will I hand over to Adrian and Sabine. Thank you so much.
Thank you very much, Katja. Well, that brings us to the end, and also two important message. I do the first. That is a big thank you for you to come here, also to the fellow speakers here, and for the organization committee here at Building Bridges. Sandrine Salerno was here. Without her, we wouldn't be here. That's my part. Thank you very much. Looking forward to see you next year. As you heard it, we're under time pressure to come up with a self-regulation. And Aurelia and I, we have set ourselves a goal. Next time on stage, we're going to present this. With this, I hand over to you for the famous last words. Very important.
Thank you, Adrian. And again, thank you also from my side to Amas for this great cooperation in preparing the recommendations. Thanks to you for visiting. One note regarding SSF, we are actually the host of today's lunch, and we all invite you for lunch now. In a quarter of an hour, we will launch our roadmap, so please be with us for that. But that's on another note. So thanks for having been with us, and we'll see each other around.
Thank you.